The US dollar has quietly collapsed 10% from its 2025 peak, and most traders have no idea what that means for their portfolio. If you're trading stocks, Forex, or commodities right now, and you're ignoring the DXY, you're trading blind. Today I'm going to show you exactly 10 ways dollar weakness is moving your positions right now, with the specific correlations you need to watch. My name is Pablo, and this is the Research Desk, where every claim is cited, every strategy includes its failure conditions, and there's zero hype. If you're new here, welcome. If you've been here before, let's get into it. Before the 10, let's set the foundation. The DXY, the dollar index, measures the US dollar against a basket of 6 major currencies. The euro carries the most weight at 57%. When the DXY rises, the dollar is strong. When it falls, like it has this year, the dollar is weak. That shift in strength ripples through every asset class you trade. Forex, commodities, stocks, nothing is immune. Here's how. Picture this. The DXY drops 1%. Almost immediately, the euro and the USD climbs. This is not a coincidence. It's a near-perfect inverse relationship. The correlation between DXY and euro USD is negative 0.95. That's as close to a guaranteed mirror as markets gets. When the dollar weakens, the euro strengthens. If you're trading this pair right now, the DXY is your leading indicator, not a lagging one. Imagine you're holding gold positions and you're wondering why gold is surging. Check the DXY first. The correlation between DXY and gold is negative 0.8. When the dollar falls, gold rises, because gold is priced in dollars globally. A weaker dollar makes gold cheaper for foreign buyers, driving demand up. With the DXY down 10% from its peak, gold's move this year isn't a mystery, it's just math. The same logic applies to oil, copper, and every dollar-denominated commodity. A falling dollar gives foreign buyers a discount. They can purchase more with the same amount of their local currency. That drives demand up, and prices follow. Watch the DXY when you're trading WTI or Brent. It's the macro tailwind or headwind you can't ignore. Here's one most beginners miss. The correlation between DXY and USD Japanese yen is positive 0.80. When the dollar weakens, the USD JPY falls, meaning the yen strengthens. This matters because the yen carry trade, where traders borrow cheap yen to buy higher yielding assets. It unwinds when the yen surges. A falling DXY can trigger a chain reaction in global risk assets. It's not just a Forex story. Picture this. The DXY drops 10%. Emerging market currencies like the Brazilian real, the Mexican peso, the Indian rupee all strengthen relative to the dollar. That means foreign investors earn more when they convert returns back to their home currency. Emerging market ETFs and equities historically outperform US large caps during periods of sustained dollar weakness. That's the trade right now. Imagine Apple earns $10 billion in Europe. When those euros get converted back to dollars, a weaker dollar means Apple reports more in dollar terms. The S&P 500 companies earn roughly 40% of revenues overseas. A sustained 10% dollar decline can add 3 to 5 percentage points to the S&P 500 earnings growth. This is why multinational stocks like Apple, Microsoft, Coca-Cola tend to outperform during dollar downturns. Here's the flip side of that trade. Small cap stocks like the Russell 2000 companies earn most of their revenue domestically. They don't get the currency translation boost that multinationals do, but they also don't carry the currency risk. In a falling dollar environment, multinationals lead. But if you're risk averse, small caps offer a cleaner domestic story. A falling dollar is an inflation signal. When the dollar weakens, import prices rise. Everything from electronics to raw materials gets more expensive. That pushes inflation higher, which puts upward pressure on bond yields. What's the 10-year yield alongside the DXY? When both are moving the same direction, something macro is shifting. Right now, pay attention. Bitcoin and the DXY have shown an increasingly inverse relationship over the last 3 years. When confidence in the dollar falls, as it has this year, alternative stores of value attract capital. This isn't a perfect correlation like the euro to USD. It's more of a macro sentiment trade. But a DXY trending down at 10% from its peak is a tailwind for Bitcoin, not a headwind. Here's how to use all 10 of these in practice. Every Sunday before the trading week opens, check the DXY weekly chart. Ask yourself 3 questions. Is it trending up, down, or sideways? Has it broken a key support or resistance level? What's the macro catalyst? Is it Fed rates? Is it inflation data? Is it geopolitical risk? Those 3 answers will tell you whether to lean long on commodities and multinationals, hedge your bond exposure, or start watching the Euro USD for a breakout. This is what institutional traders do every single week, and now you can do it too. Now, if you want to go deeper on how macro signals like the DXY connect to an actual trading system, I put together the complete trading strategies playbook. It's 80 pages, 20 plus strategies, every single one cited with academic and quantitative research. Same methodology as everything on this channel, including the failure conditions, because no strategy wins every time. It's a one-time download, lifetime access, link is in the description. But right now, let's close this out. The DXY is down 10% from its 2025 peak. That's not noise, that's a macro regime shift. 10 weights is moving your portfolio right now. The Euro USD, gold, oil, the yen carry trade, emerging markets, US multinationals, small caps, bonds, crypto, and your weekly prep framework. Save this video. The correlations don't change. The DXY always tells a story first. If this gave you an edge today, smash that like and subscribe button for weekly market research. It's free every week. Tell me in the comments, which of these 10 trade setups are you watching right now? Until next time, trade smart, stay curious, and keep your emotions out of your portfolio. Thanks for watching, guys.